Let's continue our understanding in free cash flow. In earlier session, we have taken a case study where we derived the free cash flow. Then using the free cash flow, we derived what is the value of the firm, and that value was compared with the price that is agreed to be paid. Then we have taken a decision, yes, that company has got more value and the price what we are paying is less, so we can go ahead with the decision. But there the assumption is the value of the company is fully based on equity. I mean, it was assumed that it is a equity funded company. But it is not necessary that it should be only equity funded. You can have a combination of debt and equity. So what we'll do now is we'll take the data as in the previous case and we'll assume that market value of debt of that company is 200 lakhs. And there are no further growth prospects after 6th year, and that free cash flows at that time carries a book value multiplier of 4. So now we have to determine if recommendation to go ahead still holds good. See, already we have derived the value of the firm on the assumption that it is a fully equity funded. Okay, and what was the value which we have derived? Let me write that. The value of firm, assuming it is fully funded by equity, and the price that was agreed on the assumption it is fully funded by equity is 1449 lakhs. So I'll call this as value of debt. And now we have come to an understanding that there is a market value of debt. So this is value of equity, not debt. Okay. Yeah, now we have come to an understanding that there is a market value of debt which is 200 lakhs. So item number 2, value of debt which is 200 lakhs. So now these two put together will give us what is the total value of the firm. So I'll put it here, total value of the firm, which is item number 1 plus item number 2, and it is 1649. This is the value of the firm if this firm is going to have debt. So I'll call this as step 1. But in the case we have another information that there are no further growth prospects after 6th year, and that the free cash flows at that time carries a book value multiplier of 4. So after year 6 there is no growth prospect, and after year 6, or I would say the terminal value after year 6 is going to be the free cash flow in the 6th year multiplied by the book value multiplier of 4. So we'll find out what is the capitalized value of or say the terminal value which is capitalized. I'll call it a step 2. Step 2 is nothing but capitalized terminal value. It is capitalized terminal value, and for that we should pick up what is the free cash flow in year 6, and that should be multiplied with book value multiplier. So the capitalized terminal value is nothing but free cash flow in year 6 multiplied by book value multiplier. So what is the free cash flow in year 6? We have already calculated. It is 395. 395 lakhs into book value multiplier, which is 4. So this would give us what is going to be the capitalized terminal value, which is 1580 lakhs. That is 15.8 crore. Okay. So now we have the capitalized terminal value, and we know the free cash flows for year 1 to 6. So we'll take those free cash flows and we'll also take this capitalized terminal value. Then we'll discount those cash flows at the discount rate, which is 18%, right? So we'll go and do that. Step 3. In step 3, basically we are going to find the cash flows or we are going to find the present value of cash flows. Okay, so let me put it here. We are choosing the discount rate as 18% because we are assuming there is no growth after 6 years. So that's why we have this 18% rate. So we'll compute present value of cash flows. So we'll write here 1, 2, 3, 4, 5, 6, and in the 6th year we'll have again terminal value. So what are the free cash flows? Free cash flows in year 1 to 6 are 147, which we have already calculated in the previous session, 188, 253, 348, then 368, then 395, and terminal value which we have calculated here is 1580. So it is 1580. Now these have to be discounted at discount factor at 18%. So discount factor year 1 is 0.8475, year 2 0.7182, year 3 0.6086, year 4 0.5158, year 5 0.4371, and year 6 0.3704. So that have to be repeated for terminal value, which is 0.3704. Now multiplying this, we'll get the PV. PV for year 1, 147 into 0.8475 will be 124.58. In this way we have to multiply for all the values. Let me do that. So I have calculated and PVs are available. Now what we have to do is we have to total them, and if I total all this, I get the value as 1485.47. So this is the exact worth of the business, okay, if the cash flows are going to change in this pattern, okay. But we have already arrived at a price, or we have already arrived at the total value of the firm, which is 1649, and this is the price which we are going to pay. But what is the actual worth? It is 1485. So here we'll write actual worth of the business. Actual worth of the business is 1485.47. And what is the agreed price? Agreed price is 1649. So actual worth is 1485.47, whereas agreed price is 1649. So now we notice that when there is a debt component, the offer price is not a right one. The offer price is not a right one because offer price is greater than the actual worth of the business. So it is said as unwise. It is unwise to go ahead with the project, or say to go ahead with the acquisition.
Thank you for watching this video. Hope you liked it. If you wish to learn more on this topic, do check our comprehensive online course. I have given the link in the description below. If you like this video lecture, do not forget to click on that like, share and subscribe button with bell icon.